Hi, and welcome to the Stockscores Market Minutes for October 10th, 2011. Quick reminder, you can read my free weekly newsletter by registering at stockscores.com/newsletters.asp, address there on your screen. Let's get right into the analysis. So this week I want to talk about what I consider to be the most important chart. And this is really a generic term to help us understand what is driving the market. The most important chart is always going to be changing. And what's important is to figure out what is the most important factor driving the market. Now, the market is something of a puzzle. All of these different indexes and ETFs, they all connect to one another. And if you look at them all as a group, you start to get a sense of what is really driving the market. And once you figure that out, then you can tailor your strategy appropriately by focusing in on that most important chart. Well, let's do that for this week. If you take a look here at the chart of the TSX 60, someone last night said to me, Tyler, why is the Toronto Stock Exchange doing more poorly than the U.S. stock market when you consider that the unemployment rate isn't as low, that the economy is stronger, that the banking system in Canada is stronger? It makes some sense that the Canadian market index would actually be holding up better. The reality, of course, is that it is not. When you look at a chart of the S&P 500 against that TSX 60, you can see that the S&P 500 is doing much better. So we need to start to put these pieces of the puzzle together to figure out what is really driving the market. Now, I've done that already, and really the most important chart right now is the chart of the euro currency. Because what is driving this market is, of course, the concerns about the banking system in the European Union. This chart seems to drive everything else, because out of the euro, when the euro goes up, the dollar goes down. Of course, the euro has generally been going down lately over the last month or so, 5 or 6 weeks. And so as a result, the US dollar has been going up. This is a chart of the US dollar index ETF. So this is a basket of currencies against the US dollar, the biggest of which is the euro. Now you can see that when the euro crisis really started to take hold early in September, the US dollar climbed pretty steeply, despite the fact that the US government is printing a lot of money. Money was flowing into the US dollar as a safe haven. Well, over the last 5 or 6 days, that has started to reverse, and we can see that the US dollar has weakened while the euro has strengthened. And that tells us that the market is beginning to sense that there will be some resolution to the problem in the European Union and its banking system. And that is really what is driving the market. Because if the US dollar goes up, it makes anything priced in US dollars more expensive. These are commodities and, of course, US stocks. And that has hurt the US stock market, not to mention the fact that the uncertainty about the banking system in Europe has also hurt the US stock market. But it has hurt the Canadian stock market more because of the Canadian stock market's heavy weighting in commodity stocks. We have a lot of gold stocks, oil and gas stocks, mining stocks, that sort of thing. And a strong US dollar hurts commodity prices, which hurts the Canadian market. So even though the Canadian economy is stronger, even though unemployment is less in Canada, the fact that the US dollar has been strong, the Canadian dollar has weakened, and that has made many of the important sectors in Canada suffer. Now here you can see a chart of gold, and over the last 4 or 5 days, gold has started to strengthen as it bounces off of its long-term upward trend line. That is because the US dollar has weakened, the euro has strengthened, and that has allowed people to come back into gold and start to maintain that long-term upward trend that has been in gold for some time. So that is how we put all the pieces together. Here you can see also the chart of oil. This is an index ETF. It's not exactly oil, but it's pretty close. And that has strengthened over the last few days as the European Union currency, the euro, has softened, and as the as the euro has strengthened and as the US dollar has weakened, oil has been able to improve. So let's do some analysis now. The TSX remains in a downward sloping channel. The market was closed on Monday in Canada, so we should expect that this market will gap up, but it needs to break that upper boundary of that downward sloping channel before we get too excited about Canadian stocks. Now, there is an opportunity to buy stocks when they are at the lower boundary of the channel. That happened 4 days ago, but that opportunity's kind of passed bias now, and so we should be looking at the longer term picture for a break of that long-term downward trending channel. The S&P 500 is also in a little bit of a downward sloping channel, not as intense. It broke the steeper one that's been underway over the last few weeks. I think that the U.S. stock market probably can go a little bit higher here, but it's going to take some time before it can break out of this very, very volatile chart pattern. And really, when I look at this pattern, I think to myself, it's really a market that should only be swing traded or day traded right now. It's just too difficult to invest in this market because there's so much uncertainty. Gold, as I said, is bouncing off of its long-term upward trend line. This is something I discussed last week when it made the first bounce off of the trend line. It did that again and is now starting to move higher. It's going to take some time for gold to move up. I wouldn't say it's going to rocket higher like it has in the past, but it should slowly inch its way higher as it moves along that upward trend line. So I think the gold sector is a safe place to be. Although it may not give you explosive gains, it should be giving you gains nonetheless. The market for oil remains in that downward sloping channel, but we are testing the limit of that channel, and a break through that should signal the beginnings of a reversal in oil. And of course, if the euro continues to strengthen and the US dollar continues to weaken, that should help oil because of course it makes oil cheaper globally. So my outlook then is I am now neutral on US stocks. I am pessimistic on Canadian stocks, but I do think that that could change very soon. On gold, I remain optimistic. On oil, I am pessimistic, but also I think that could change very soon. A reminder that this is a trader's market, but the seasonality of the market, of course, the market tends to rally from October till May. Seasonality makes it a good time to accumulate stocks that are breaking their downward trends. So watch for that. Just draw a line across the tops, and if you're getting a break of those downward trends, you'll probably have an opportunity to start to buy those stocks for the longer term. Well, that has been the Stockscores Market Minutes for October 10th, 2010. Once again, if you would like to subscribe to my free weekly newsletter, do so at stockscores.com/newsletters.asp. Have a great week in the market and trade well.